But of course, it can't be gold at $2,000 an ounce. It will at some point be gold at $20,000 an ounce or $30,000. I'm not making a forecast in the gold price. What I'm saying is that gold, to be a serious reserve asset, will need to be revalued. And the other thing is, of course, with future demand, there is no more supply of gold. You can't refine more than about 3,000 tons a year. And therefore, the only way to satisfy a higher demand for gold.
Coin price forecast experts gold rate prediction 2023 is around $2,030. The upward trend will continue in 2024. Analysts expect gold to rise to $2,032 in the first half of the year. By the end of 2024, the price will be around $2,100 per troy ounce. Egon von Greyerz, the visionary founder of Gold Switzerland, possesses a profound understanding of the global financial landscape and stands as a prominent figure in the field. In this video, Egon anticipates gold value to reach $20,000 or $30,000 in the long run, driven by the need for revaluation as a substantial reserve asset. He states that central banks are buying more gold, with a slight March surge due to banking crisis. In the 3 months to the end of March, central banks added 228 tons to global reserves, the highest rate of purchases seen in a first quarter since the data series began in 2000, though a slower rate than in recent quarters. Egon highlighted U.S. dollar devaluation and the eastward shift through BRICS, potentially eroding the dollar's global trade currency status. Experts in the U.S. are deeply divided on its prospects. U.S. Treasury Secretary Janet Yellen believes the dollar will remain dominant as most countries have no alternative. Yet a former White House economist sees a way that a BRICS currency could end dollar dominance. Egon sees massive money printing due to mounting U.S. debt causing the dollar's rapid abandonment, impacting other Western currencies. Meanwhile, rising interest rates and the recent debt ceiling crisis in the U.S. have raised concerns among other countries about their dollar-denominated debt and the demise of the dollar should the world's leading economy ever default. Now we are presenting you the glimpses of Egon von Greyerz insights from his recent interview with Jay Martin. Before we continue to delve into this discussion, we request you to subscribe to our channel and activate the bell icon for timely updates.
At this point, you're seeing some central banks and some countries buying gold more than you've seen before, but there is not a gold rush at all. There's not. If you speak to the refiners around the world, things are quiet. I'm talking about, I'm talking about currently or even this year. It's been a quiet year. I mean, okay, so you have a little bit of a flurry when in middle of March when banks go under, but overall there is no fear yet. So we've been into this business for almost 25 years. And we've gradually built up a major business helping people to preserve wealth and by having physical outside the financial system. But what I've been seeing and the risks I've been worrying about and the trends I'm seeing and what Luke Groman is seeing more than ever now is that gold is going to be the beneficiary of all the problems in the world that he's also analyzing now, Luke, for example. And so what I'm saying is we've been in this for 25 years. People are buying, and it's gradual and it's steady. There's nothing dramatic yet. So what I'm seeing, what I'm expecting, it hasn't happened. So I'm actually telling my people, my management, etc., my colleagues, we haven't started yet. We haven't even started yet helping people to preserve wealth because the real gold rush is still about to come. And that's not a gold rush for the sake of owning gold. That's a gold rush for the sake of protecting your assets against what's going to be the biggest financial and economic collapse in history. And the debasement of the currencies. I mean, that's happening in front of our eyes every day. And with the BRIC, as you mentioned, with the BRICS countries, with the SCO, the Shanghai Cooperation Organization, this shift from the west to the east, it's going to be, and therefore shift away from dollar payments of commodities and oil, etc. That's going to be disastrous for Western currencies and with the dollar first, because that's been the main trading currency of course. And that shift is going to have a major effect on the gold price. When Luke has mentioned Groman, and I'm in total agreement with him there that you cannot have a system of central bank reserves being held in a currency which has zero value, and now also, and it's going to be printed at a speed never seen before, because the US debt is going to increase incrementally or exponentially, and so therefore, the people are going to run away from the dollar very quickly, and that means also all other Western currencies also. Instead of having who the hell wants to hold your reserves, your central bank reserves, in a currency that can be frozen, confiscated overnight, like America is doing? Nobody will want to do that. So the move away from the dollar from that point of view will be massive too. And then also from the point of view that it's not going to be petrodollar anymore, because the payments for commodities now, with a shift from east to west, from west to east, is going to also really hit all the currencies and the dollar, of course. So therefore, the most natural replacement of the dollar as a central bank for central bank reserves will clearly be gold.
During the interview, Egon highlighted the gold's significance in the early 2000s amidst global challenges and potential defaults. In 2000, gold was at its lowest in a decade at $274.50 per ounce. Subsequently, gold prices surged, especially after the 2008 economic crisis, as it gained recognition as a strong investment. Egon notes post-1971 debt surged due to power misuse and warns of potential market and bond collapses, foreseeing severe global economic impact. In July 2023, the public debt of the United States was around $32.61 trillion US dollars, around $2 trillion more than a year earlier, when it was around $30.6 trillion US dollars. US bond investors were gauging how to navigate a prolonged period of higher interest rates that some expect to weigh on US growth, after the Federal Reserve on Wednesday, 27 July left open the possibility of more rate increases and excluded easing financial conditions anytime soon. According to Egon, the growing defaults, bankruptcies, and Fed's concern over underlying issues. However, there's little evidence that gold is consistently weakened by federal funds rate hikes or treasury yields. Let's get back to interview.
Well, let me just go back a little bit. So, we started with in the 90s, I was worried about the world and the risks in the world. And then I was looking at the consequences also, and therefore, how do you protect yourself? And that's how we started buying gold for ourselves and the people we advised in the early 2000s. At around $300, we went in heavily then at $300, and not because we were in love with gold, but we saw gold as the most natural consequence of a world which was going to have problems, both from the point of view of debt and of currency debasement, and of risk and of defaults. The only way to satisfy a higher demand for gold, which will happen both from investors' point of view, private investors, and from the point of view of central banks, will be a much higher price, because there won't be more gold around. It'll just be that the gold will be more valuable. And that's going to happen. Well, I have infinite patience, and only limited by my own age. But things will go on after I'm not there anymore anyway, so it doesn't really matter. But therefore, I don't care if it happens tomorrow or in a few years' time. It will happen, and it will be a massive shift, and people who don't see that will be left behind, and it'll be very costly for them. The risks I'm looking at around the world, and of course we have to add to the 325 trillion global debt. And remember, in 1971 it was only 4 trillion. It's gone from 4 to 375 since Nixon closed the gold window. And that shows you what happens when discipline goes. It's a free for all. And of course, that's made a lot of money and a lot of people very wealthy, and also given a lot of people a lot of power that is totally abused. But it's all leverage, and that leverage is now going to just implode in at some point. I mean, the risk is very high. I don't forecast timing any more of these things. I'm just saying I'm quite happy with just protecting my risk as far as I can, and let other people speculate in the markets and ride the last bit of the stock market up, which I think actually is not going to happen because I think it's finished. But that implosion of debt markets, implosion of bond values, that's what's going to kill the world economy totally. The first warning sign we got recently was, of course, the Ides of March, the middle of March, when 4 U.S. banks went over, and a few days thereafter, Credit Suisse, the second biggest bank in Switzerland, went under, or was taken over because there was fear that it would go under. And I think, to me, I mean, those kind of signals we get more and more of, and of course we know that defaults in the consumer market is increasing constantly. Bankruptcies are increasing, but it's not at a level yet when there is panic. But you take the banking sector. The Fed is basically instructing banks on a daily basis to reduce their lending.
The future global economy is uncertain due to multiple factors. Gold prices, impacted by challenges like debt surges and potential market disruptions, are of key interest to observers. In the face of market disruptions, how do you see gold playing a role in wealth preservation? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.